Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to the Cedar portfolio. We're going to explore the investment philosophy of a unique approach to ESG investment strategy. I am Richard Bernoulli, CEO of Cedar Gold. Our firm has developed this strategy and the associated ESG index that we manage. Today with me is Charles Hughes Smith. He's author, leading global finance blogger, and America's philosopher, we call him. He's the author of several books on our economy and society, including A Radically Beneficial World, Automation, Technology, and Creating Jobs for All, Resistance, Revolution, Liberation, A Model for Positive Change, The Nearly Free University and the Emerging Economy, Pathfinding Our Destiny, Preventing the Final Fall of Our Democratic Republic, and Will You Be Richer or Poorer? His blog of twominds.com is one of CNBC's top alternative finance sites. Welcome, Charles.
Thank you, Richard. Well, I'm excited to talk about ESG because for several reasons. One is that we're seeing a lot of references to ESG in the financial media and social media, but most people aren't really describing what it actually means in the real world. And so I'm hoping that we can shed a little light and a little context on what it actually means in terms of choosing investments and what the impact could be for the world economy. And then I'm also interested in the topic because ESG is kind of like where the rubber hits the road in the topics that I write about that I feel are essential to the improving the global economy and making it sustainable, which would be relocalizing the economy, decentralizing the economy, funneling capital to local communities and giving them a say in how the capital is invested and used, and supporting local labor force, creating good paying jobs in a sustainable fashion. So I think that's kind of what I'm hoping we can discuss. And since you are better informed than I am about the ESG space, I was hoping you could contextualize for us, like what does it mean as a general trend?
Sure. Well, first and foremost, ESG stands for Environment, Social, Governance. So that's the first letter of each of those words, ESG. And essentially, it's a focus on these aspects in the investing process, more of a focus of stakeholder capitalism, if you will. So it's not just looking at shareholder capitalism, the investor, the shareholder, but looking at the broader spectrum, the community where businesses operate, the customers, the investors as well, and who is basically applying these in terms of being partners with the business. So it's a whole slew of all of the stakeholders all together. And it's very interesting because the environment for this is growing quite rapidly. The level of ESG assets currently is over $53 trillion US, depending on how you calculate it. But if you look at all of the ESG related assets, it's well over that amount. So it's a significant asset class in and of itself now internationally.
Right. And so what I'd like to talk about, because this is a question I have all the time when I read about a company's ESG efforts or their public relations about it, what I want to know is it real, or is it just are they just making use of a buzzword to make themselves look progressive? And so I'll give you an example that maybe we can introduce, and then we can discuss the difference between the sort of superficial ESG and what I would call legitimate ESG. which is in the long-term investment of capital in a stakeholder environment that you described. So, like say, we all know that lithium mines are horrible places, like many other deep mineral mines, where they use a lot of water, that they're depriving the local community of that water, and the lithium and all the profits from the mining are shipped overseas. And so a lot of companies I noticed that use lithium in their lithium ion batteries are trying to claim ESG by sourcing this responsibly. And of course, that's a very complicated topic, something that's very easy to claim and very difficult to accomplish in the real world, because the model, if it's extractive and exploitive, which is the general, I'd say the conventional investment strategy in the global south and in the developing world, that capital goes in from the first world and then exploits local labor, extracts the resources, and then leaves the place in ruins. I think that's been the model for at least 50 to 60 years, if not arguably 200 years. And so I think I'd like you to speak to a little bit about ESG is an entirely different model, in that rather than seeking to maximize short-term gains by exploiting local resources and labor, it's really attempting a partnership that's sustainable. And I think that may be one way to differentiate between superficial ESG and legitimate ESG. Would you say that's a fair assessment?
Yes, exactly. And it's generally referred to as whitewashing, or just having the ESG label as itself, in terms of being superficial. So there are a lot of funds out there that just put that label on, not really doing much in the way of specific activities or approach. And that's where our approach is very differentiated. And at the outset here, what are we talking, like, why is this powerful to begin with? Well, we take the view that this is a very powerful complement to nonprofit organizations and charities, because you're essentially investing and outright promoting businesses that are helping society and the environment in a good fashion. So it's very powerful because it's part of the economy. You're directly affecting and influencing and helping the economy directly, rather than through donations or just partially trying to help aspects of the economy or results of the economy. So this is much more direct and much more powerful. The other aspect of this is governance. The ESG factors are rated publicly, like for publicly listed companies. And so this is very important, because the G in ESG governance can also identify businesses that are doing well in their governance, like how they approach executive compensation, how they're running their business, the committees, what type of best practices they use internally to run their business. And we see this as being much more powerful because there's a rating assigned to that, unlike in the nonprofit and charity world, where they may not be. And this goes along the lines of how well are dollars being allocated to helping impact investments, so that when you do this through businesses, there are these ratings, and they can identify if there's weak points, in the CEO structure, the C-level management, executive compensation, labor relations, all of that will factor in. So that's why we think it's very powerful, to take this approach. The aspects that we emphasize to sort of ensure that it's a legitimate ESG are many. So, and some of these are actually unique to our approach. The The first thing we do is we take an integrated ESG view. So a lot of people will only look at ESG investing. So they look at the factors that are rated for ESG performance for a business or a set of businesses in a portfolio, and that's all. But what we do is we look at all three areas of the ESG view, and that is ESG investing. So that's the first part of it, looking at ESG factors. But then there's also something called SRI, socially responsible investing. And that's interesting in and of itself, because what's happening there is the application of positive screens and negative screens. So you essentially can define areas where you shouldn't really have businesses doing work in, or you would rather not have them do work there, like building weapons or gambling type of operations, in terms of negative screening. But on the other hand, you might also want to have positive screening, which is on the other side of the equations, in terms of looking at businesses that do things in social justice, involvement of charitable cause contributions, even like board independence, reasonable compensation models at the executive level, the emissions of greenhouse gases to emphasize low emissions, low waste generation, and humane working conditions and health safety at work. So those would be examples of positive screening. So that is an integrated view of those two areas. Plus we do a third area as well. So it's ESG investing, SRI investing, and the last is impact investing. And this is very interesting because it's the application of impact investments made by the business, because it's the right thing to do, and it also can be beneficial as a feedback mechanism to the financial performance and success of the business, as well as its equity performance. And we've done a lot of studies on this in terms of analyzing the correlation between sustainability, doing impact investments, equity outperformance, financial outperformance, and looked at studies that have been done around the world over many years, and it's all synergistic in that sense. So we make sure businesses are also doing impact investments as well. So it's ESG investing, SRI investing, and impact investing. We also are a signatory to the United Nations Principles for Responsible Investment. So that's UNPRI. So this is very interesting because it's a mandate by the UN to have portfolios look at responsible investment, and it involves detailed guidelines, reporting type mechanisms that are in place for reports on what your portfolio is doing, how can it be measured, yardsticks for different portfolio activities, and the overall investment process. So it's quite structured and helps to align the investment process towards responsible investment. And another area of this, which is included as part of some of the activities in the UNPRI, is active investing. So what this means is you become an active investor in the businesses, not just a passive investor. And we've launched a program in this regard to provide essentially consulting advisory to the businesses that we have in the portfolio. So we look at how well they're doing things, or what areas could be improved, either through consulting or technology, innovation, continuous process improvement. And we actually reach out to the businesses to provide these suggestions for enhancing their business towards greater financial success and greater equity outperformance, ultimately. Another aspect in our approach is that's very unique and that really makes it legitimate ESG is we incorporate the 17 UN Sustainable Development Goals. So there's 17 of these, and we incorporate the promotion of these goals by the businesses as part of our analysis. We only invest in successful businesses that meet our high standards for helping society and the environment that are aligned to these 17. So we're constantly mapping how these businesses approach each of these 17. And these 17 will map into 169 target initiatives. So we actually break it down a level further, all 17 into a collection of 169 altogether, target initiatives. And we keep track of that on an ongoing basis, as well as part of our analysis in terms of the investment qualification process in order for businesses to be in the portfolio. And last, but very important, is we take a market-based approach to environmentalism. This is a very unique approach that we have. So this is a differentiator because we do not take an agenda-based approach. So we don't have any agendas. And it's what's called market environmentalism. This is a unique approach. We actually have a podcast program called The Green Market that is dedicated to discussions around this form of environmentalism called market environmentalism. And it emphasizes 4 areas. The 4 areas are quite interesting. They are the market economy, so emphasizing the natural market. A lot of people will call it today is the new terminology, the market approach. And so the idea of having a more free economy, you'll have better environmental outcomes. They become more efficient, more environmentally conscious, and leads to gradual decoupling of economic growth and pollution. So that's quite powerful, that one principle on market economy. Another principle is private property rights. So what this means is an incentive that happens when you actually own the property. You have a more vested interest. You're more likely to take care of it. That which no one owns, no one cares for. So it's very powerful. Ownership stimulates stewardship and responsibility. Strong property rights also include the ability to trade resources, which allows for markets to reallocate natural resources for conservation purposes. And there's many examples of that success. Third principle is decentralization. And this is very interesting because there's an emphasis on local communities, how they're better placed than governments, maybe located hundreds of miles, hundreds of thousands of kilometers away in a capital. So the local population is more attuned to what's happening, more able to provide local solutions, shared resources. And so that's the third element of market environmentalism. The last is optimism and innovation. And this places a strong emphasis on innovative ideas, solutions that have to do with technology, applying technology, but only in a sense that it goes towards market environmentalism. So there's a big difference here of applying technology in a good sense versus applying technology in a sense that entails a significant monitoring, surveillance, and even authoritarian type approaches where behaviors are aligned and modified and changed. So we recognize that human nature is the same, and so this approach of authoritarian or trying to change human nature, we don't feel will work, it ends up in disaster, and there are some agenda-based approaches now being pushed internationally in this regard. So we feel market environmentalism is the way to go, and so that is the last element that really provides a view that towards not only the legitimacy of our ESG, but very unique approach.
Well, that's a fantastic overview, Richard, and this is a multi level topic here that you've elucidated, and I just want to contextualize it rather briefly here, at least from my point of view, is that, and I'll mention a couple of books that by people who have elucidated the problem, and I think the main context I see is that the so-called first world, or the developed world, has an excess of capital, right? And it has expertise in managing that capital, and how that capital is invested in the developing world is the core issue here. And as I said, for hundreds of years, that it's generally been invested to exploit and extract without regard for the environment or the local community. And there's a couple of problems that your approach actually solves. And one of them is described in a book called White Man's Burden. And it's by the author is an expert in this sort of charity, foundation, trust type investments in Africa, which have not been successful. Billions and billions of dollars have been poured into development schemes, and with the intention of helping local communities, but failing to do so because they were all top down, and they were generated in foundation headquarters in New York, and then they were corrupted by local central authorities, right? Local governments that are central governments that are corrupt. And so your approach solves that problem because you're going directly into the communities and giving them agency, which is a say, as you say, a stake in the process and a stake in the outcome. So there's incentives for them to get involved and be productive. And the other problem was that you mentioned the lack of private property rights was described in this book, The Mystery of Capital. And so that's another huge problem in terms of funneling capital in a productive way, right? If you don't have property rights, and by this we mean not just ownership of a piece of land, but you might have, the community could have rights over a forest, for example, to extract that in a sustainable way, even though it was owned by the government, say, or a corporation. And lastly, I just want to point out that the other really powerful tools here that you're describing is transparency in a very large and significant way, which is often missing from how capital is actually invested, right? And so if you have transparency and an objective standard for that transparency, i.e. rating these opportunities and governance structures, then that's how we really make progress globally. And I'll give you a quick example, which I know of firsthand, which is the whole rating of sustainable forestry, right? That you know, when you go to the lumber yard, you can actually see that some of the lumber has been stamped or tagged as it's been raised and harvested in a sustainable fashion, and that there's oversight that and a mechanism for actually legitimizing this, as opposed to just sort of claiming it, you know, offhand. And so I see all these very powerful improvements in how capital is allocated on a global scale in the system that you described.
Yes, exactly. Those are great points, Charles. And we wanted to emphasize also our mandate is dual. So a lot of people will have the question, how can you generate outperforming portfolio returns? We take a dual mandate approach, so we have an emphasis not only on helping society and the environment, but also targeting outperforming returns at the same time. And if I can take a bit of time to describe that approach, it's quite powerful and also another unique aspect of our investment strategy. So our approach is based on the principles of a unique school of thought that was developed in the 1870s by some economists in Vienna, Austria. So it became known as the Austrian School of Economics. Nothing to do with the country of Austria other than that the initial economists came from Vienna in Austria. And this school of thought is very interesting, very powerful, and also is aligned with many of the principles and the themes that you've written about extensively in your books that we mentioned at the beginning and blog posts on your blog that have to do with issues, challenges, and trends in the economy and the financial markets. I was wondering if you could elaborate a little bit more on this, and these would be areas that you write for themes relating to localized, decentralized focus, minimal debt and leverage, massive unsustainable debt and leverage, and number 3, total value in areas that you see that include not only financial capital but social capital. And just wanted to hear how you write about these, what your thoughts are, your perspective, because they're very aligned to the principles of the Austrian School of Economics.
Right, and I'm glad you brought that topic up. That what I write a lot about, as my readers know, is financialization and globalization, in the sense that these are twin evils to some degree, because financialization distorts markets, so they in very negative ways, and so people make poor choices because they've been given a distorted market, and so the idea here is to strip out the over financialization of assets and markets, where and really the core of financialization is that real world assets are collateralized and then into this endless chain of basically extracting profits from phantom capital, right? That and by loading up debt and using leverage to extract profits without actually creating any value. And so, meaning there's no better jobs, there's no better governance, there's no better quality goods and services. And so when you talk about total value, I think that's an extremely important topic, because that's what's missing when people talk about the so-called benefits of financialization and globalization is there's no look at the total value of these forces. And so I think what total value means to me is that that it covers both the improvement of the producers, the workers and the communities. It improves their lives, right, and their prosperity. It creates better goods and services, that in the sense that they're more sustainable, higher quality, and that they can be extracted over time without destroying the source, right? And so that adds value to the global economy, right? Because if you're not going to have a sustainable economy, then you're basically going to burn through your fisheries, your soil, your fresh water, your resources, and then you're going to have nothing. So obviously that's not a value proposition. But that's the way that so much capital is now being invested. And so total capital, as you mentioned, also includes social capital, which is the fabric that holds society together. And so when you distort markets with globalization and financialization, you end up unraveling the social cohesion of a society by distorting the markets and governance with huge amounts of financialized capital and extractive sort of globalization. And so what I hear you proposing is a relocalizing form of globalization. In other words, that there's access to the global markets in ESG, but they're accessible in a sustainable way that actually benefits the local community and the producers, and it also produces a good return for those investing the capital. And so it's obviously a win-win. And what I think we also can see in your presentation of total value is by relocalizing capital investments and seeking like impact investing. This is what's missing from so much of the developing world, is that the capital that's invested is extractive, but it's not really making an impact that smaller, more targeted investments can make, and in terms of boosting the productivity, and that's where you get the outsized returns, right? You get the outperformance by investing in ways that create tremendous productivity in local communities that didn't have the capital or the expertise to generate productivity. And so what I see, again, sort of in a broader context, is what you are proposing is ways that capital can increase the productivity in very low productivity environments. And this is how you get the outperformance, and this is how you generate prosperity in the local communities who had the will and the desire, but they didn't have the capital or means to increase their productivity. So I think, and when we talk about total value, what we're really trying to talk about, I think, is creating a sustainable economy that benefits both the holders of capital and also the local community by boosting sustainable productivity.
Yeah, great. Those are all awesome points. And so that's why we take this approach of the Austrian School of Economics, more specifically in terms of the principles. We look at this School of Economics as emphasizing savings and investment, minimal or manageable debt and leverage, businesses with very healthy, positive free cash flows, elements of innovation, longevity in business, and also store of value in different ways, different perspectives. So given those principles, what we've done is extensive research on translating those principles into factors. So we have identified 14 smart beta factors in the portfolio. 7 are quantitative, 7 are qualitative. And for the quantitative ones, we came up with a set of 7, of which each one have studies indicating equity outperformance, correlation to equity outperformance on each one of those individually. So the metrics that we've come up with that corresponds to the principles of the Austrian School of Economics, those 7 factors have actually correlation to equity outperformance individually. So if you think of probability and statistics, if you look at a business that can meet all 7 of those at the same time, that provides a significant edge, much higher probability than one factor alone, to have all 7 of those factors in a business in terms of the characteristics and the metrics of those in a business. We also have 7 qualitative factors, and that's where the ESG factor rating assessment comes in. We look at alignment to economic trends and also elements of innovation, risk mitigation, elements where there's holding of purchasing power inherent in the business that is part of the qualification process. So that's a bit of background on the factors. And just to mention, again, to to emphasize the 7 quantitative factors. So this is the power behind the outperformance target that we have as a dual mandate. So we need to have businesses that are not only helping society and the environment, but at the same time are successful financially and equity performance-wise as well. And the results have been quite impressive. As you can see from our website, we've got actual performance results and backtesting results. We have significant performance on an index that we have created called the Austrian Economics ESG Index. And this performance has been over 40% last year. And then to date, year to date, approximately 16% so far year to date as well. So doing well this year. And these are higher than the Dow performance, higher than the S&P 500 index performance, as well as higher than many industry peer funds. Very importantly as well is we target not only outperformance, but outperformance at lower risk. So if you look at risk parameters, we generally have similar risk parameters or lower. And by that I mean risk parameters such as standard deviation or the volatility, the maximum drawdowns, Sharpe ratio, Sortino ratio, correlation to the equity markets. So there's different parameters that you can look at, active return, trainer ratio, and so those all look favorable as well. So overall, what we have is a portfolio with very interesting characteristics. Only equities of great businesses from around the world, no use of derivatives in the investment process or portfolio, no use of debt or leverage in the investment process or portfolio, businesses with great ESG metrics, screen for social responsibility, applying impact investments, and we also do a rebalancing quarterly. We also have 2 components in the portfolio that provide for preservation of purchasing power, as mentioned earlier on one of the characteristics. So we have a small weighting in physical gold and a small weighting in physical silver as well.
You know, Richard, what really strikes me, again, looking at it from 30,000 feet about the global sort of social economy is that you are really sort of institutionalizing, if I could use that word on a local level, the incentives created by markets. And this is one of the key things that we've learned from how development goes wrong and capital is squandered and doesn't generate prosperity, is that it doesn't use the incentives that are built into markets. And so it's almost ironic that if you really do case studies, you find that if you can create markets and provide capital to local communities, they will get so much more done and create so much more wealth for themselves than if some sort of money is given to them because there's no incentive structure there. And so what I see you doing is creating a formal structure for positive incentives, and this is absolutely key to actually making progress in any problem in the human realm, right? You've got to have the correct incentives that create a positive return, and so you have that for both the investors and for the companies that are being invested in. And I think I also want to mention just that it's not a big part of what people often talk about, but there's something important in having a moral legitimacy. That, in other words, you can actually feel like your capital is doing good instead of just being manipulated by financiers somewhere. And you don't know that in the conventional investment world. You don't know how your capital is being used and for what purpose. And so what you're providing people is an option that not only has outperformance, which everybody wants, but it also has transparency and a moral agenda of helping transition the world economy away from unsustainability, but in ways that actually help the local communities and labor force, and that's really what the world needs. And so you're really shining a light on a whole way of quantifying a better way than what we've than the global economy functions at in the current sort of perverse incentives, if I could put it that way. So you're creating positive incentives, and that's really what the world needs.
Yes, thank you very much. And we also have to that end a burgeoning social media initiative in terms of all of the types of social media. We have this podcast program. We have the FRA Roundtable Insight program, where we interview some of the best economists and fund managers from around the world, such as yourself. We've had many times on the program show. And then the Green Market podcast, which we just recently launched in conjunction together with the British Conservation Alliance and the Austrian Economic Center in Vienna, Austria. So we hope this will also create and foster awareness and interest by the millennial generation community for the purposes also of serving as a platform to the community globally and locally for ideas on creation of jobs, sustainability, housing market, affordable housing. So it all goes with that as a platform from the School of Economics thought that we're using as the Austrian School of Economics. So we see a much extended value that we're providing, first and foremost in the index and in the investment strategy, but branching out to all aspects of helping the economy.
Right. You're proposing an integrated alternative to a system that is now, sadly, totally dependent on leverage and speculation, which are not positive. And so, my final comment would be, I'm really pleased you mentioned the millennial generation, which so many, from what we gather, millennial investors are putting their capital in basically gambles, driven by perverse incentives of financialization and speculation. And what you're proposing is something that is not only much lower risk, but it's a much more productive use of their capital, and over time will outperform making speculative gambles in bubbles. So I applaud your work and the formalization that you guys have accomplished, because it's very easy to talk about all this stuff. It's very difficult to actually put a system in place that makes sense of it, and that you can track this and do so transparently. And so that model you're creating is extremely powerful, and I'm glad we got to talk about it today.
Great. Thank you so much, Charles. Our website is Cedar Portfolio, all one word, CEDAR portfolio.com. And if you can mention also how our listeners can learn more about your work.
Yeah, please visit me at of2minds.com, and there's some samples of all my books for free.
Awesome. Thank you so much, Charles.
Thank you, Richard.
Okay, that went great, I think. Yeah. Okay.
I think so. I mean, I thought you were really concise, and I hope I added some value, just kind of again talking about the sort of the broader context here. And I think that, actually, people tell me I often say, well, I don't think I'm that, succinct, and sometimes I ramble, but people tell me, well, what we sense is your enthusiasm. And so I think that's what's important, is if we can come across in this podcast with our enthusiasm for this topic.
Exactly.
I think that's what makes it exciting. And I mean, I actually have to say, you've described this to me before, but in listening to your presentation here, I have like a new appreciation for the sort of formalization of it. In other words, you guys have really got it down to, like, there's quantitative things.
Yeah.
And like I said, not just quantitative metrics, but also transparency to the whole thing. Mm-hmm. And that's really important, So, anyways, I'm impressed as hell. Now, I'm not quite wealthy enough to qualify for the Singapore fund yet. But I mean, things might turn my way.
Yeah, no. So we've got a number of initiatives, and by the way, regulatory wise, we can talk anything on this index and the investment strategy. We're totally fine, and as long as we don't mention any funds or anything like that. So, and that's the way we have the separation. Our Cedar portfolio site is strictly on the investment strategy. So, which is great because we're not selling. We don't have an actual security on that website, and we're not, so we just do the research and consulting aspects. So, so that's the way we're set up with Singapore, with first degree global asset management, and so right now, like, it's sort of focused initially right on the non-U.S. investors there. But actually, I think on your level, I was doing some math. You actually sort of do reach the 2 million on the Singapore dollar threshold, based on the conversion rate. But I think it's the aspect of the U.S. citizen. I mean, it might be, So I think there's an issue there. So what we're doing is, I mean, we have some initiatives that we're looking at. The first thing is we are set up as a index licensing setup with SmartLeaf. So they're based in New York City, and the only thing is we still got one piece to work on that, where hopefully we can just make a reference to the like maybe an asset management company, or we advise your brokerage or your asset manager that they have the ability to license our portfolio through SmartLeaf, so some mechanism like that. So it's not fully clear yet, but we're working on that, for U.S. investors. And the other thing is we're looking at also potentially doing an ETF. So we have discussions with First Trust, their ETF provider, and they list in both U.S. and Canada. And so that would be easy, right? Because you just have one ticker symbol and say, hey, if you want to buy so many shares of that. So that's another initiative we have going on. So hopefully to have some good news on that shortly. Where it's very clear.
Yeah. The ETF would be fantastic, because then there wouldn't be all that FACTA stuff too. I mean, as a U.S. citizen, it's like this burden of all that FACTA stuff you have to do.
Yeah, exactly. Yeah. So I mean, I think that's why a lot of the world will usually exclude U.S. because it's just too burdening, right? The cost of the regulatory compliance is so big that they say no, we'll just handle non-U.S. investors to make it more simple, and I mean, there is a way after we've set up in Singapore to integrate the U.S. part of it with the FATCA compliance and all that. But initially, just to start out, we have that focus now just on non-U.S. investors, and it's high net worth and the institutions. So that's going to be our focus for now. With those guys.
Yeah, makes
But
sense.
yeah,
And then that's a good progression. So my hope for this, and you can send me the link of whatever wherever it's posted, but I'm hoping this can be kind of an evergreen thing that you can just leave up
yeah,
as an introduction, as part of your social media or
sure,
media thing. I mean,
yeah,
that would be, I think it's pretty evergreen. I mean, in other words, that we talk about, there's nothing topical per se.
right,
So,
yeah,
yeah. But
exactly.
I definitely, I do want to promote it. I think it's really a terrific introduction. I thought it turned out better than I had hoped. I
Okay,
know.
yeah, okay,
Other than, of
okay,
course, I tend to ramble when I get excited about the whole global capital, and all that stuff. But
yeah.
hopefully, I wasn't too
Oh no, you are
sounded too
perfect. Yeah,
distracted.
perfect. Yeah, great. Yeah, perfect. Okay, excellent. So
Yes.
let's pick. Are we okay for next month? FRA roundtable. Let's
Sure.
see on 21 July. 21.
Okay.
21 July.
Yeah.
Make it. Yeah. 21. Yeah. That's okay. And yeah, so I'll send you a meeting and a placeholder. I mean, we can just wait as we usually do, right, to see the topic du jour.
Yeah.
Maybe when some of your recent blog writings during that week or the week before.
Yeah.
So yeah.
You, one thing that we could talk about, and I don't know if I can dig up any charts other than margin debt or something, but there's just so much evidence that people are now borrowing against their houses, and millennials are taking their life savings and dumping it into like options on GameStop or whatever.
My
I
God, I
mean,
know.
it's
Yeah,
terrible. It's
yeah,
really awful.
right,
And
right.
so this speculative frenzy is so, I think it's super dangerous, and everybody keeps winning because, the Fed goes out there and talks dovish and all that stuff. But,
Oh yeah.
normally normally when it gets to this extreme, it ends really badly. And so I'd love to talk a little bit more about how ESG and what you're doing is an alternative to
Right,
this sort of speculative frenzy, that's really not helpful,
right.
and
Oh
it's
yeah.
really super risky.
Oh, they're all.
So
Some of them will. They mentioned to me, Rich, have you got into there's this cool new psychedelic business company or something, for health or something. I don't even know the business model, but it's like,
yeah,
like NMED or something. There's one that's listed on Toronto stuff. And, but yeah, they're all, and it's not just the idea of buying a share. Like you're right. They need to go to the options. It's like to total leverage to the ultimate, degree, so that, I mean, even just 1 or 2% to the downside, it's like total wipeout, right? It's,
right,
and so it just has
yeah,
to go in, it has to go in a straight line because I mean, just like even the last week, if so we actually took a bit of a setback last week, but already the first 2 days of this week we've gained back most, already of the downside from last week. But for anybody leveraged, right, on leverage with derivatives last week, it could have gotten decimated, right, depending.
yeah.
Yeah.
That's right. And then now, yeah, and these wild swings, that you have to be right, literally every day.
Right.
No.
Yeah.
So, yeah, and so I think we could have a very productive discussion about the broader trends. Like, in other words, what is it saying about our economy and our society
Yes.
that we've become a nation of like gamblers,
Right.
that the Fed has to support, right? I mean, because what happens if the market actually plummets 20% in a classic bear market?
Right.
I mean, how and all these people are wiped out.
Yeah. It's over.
So it's like, I think, I don't know. We can talk about it, but I mean, we can choose another topic. But I think that's something that really came up with me today, listening
Yeah.
to you. I was thinking, if you can make, never mind 40%, if you could even make 20% relatively safely over time, you are going to be so much wealthier than if you're gambling in Dogecoin.
Right.
You know?
Right. At lower risk, right? As I mentioned, the parameters we look at are, we compare ourselves like to that big ESG ETF, and it's lower risk. We're also lower risk than the Dow, lower risk than the S&P. So that's what you want, right? You want outperformance at lower risk, right?
Right.
Yeah.
And so that's so maybe we can just kind of look, I mean, if we have nothing else that we want to talk about, I would like to just kind of continue that conversation about how ESG, your approach to ESG is like an entirely way more productive and less risky way to build your wealth, you know, and doing something good as opposed to just wild speculation, which is not only super dangerous, but it's completely worthless socially. So
okay,
you know, we could talk about that. All right. Well, I'm glad that we got to talk about this. I feel like I got a much better grasp myself, and so I'm sure the audience is going to have a much better grasp of what you're doing.
Awesome. Thank you so much, Joe. Thank you.
Okay. Thanks so much, Richard.
Take care there. Yeah. Thanks.
Okay.
Take care.
Bye-bye. The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.